What I want to talk about today is the taxation of Social Security because I keep seeing a lot of questions on it, and I really want to clarify your understanding of how it works. So, without further ado, let's jump in and let's talk about the taxation of Social Security and how it works. All right, so how does taxation of Social Security benefits work? This is something that we'll just put on the list of things that the government does that maybe when you're sitting in a room full of people talking about things, they sound like a good idea. But if you're somebody who is transitioning to the next stage of retirement, it's just one more thing on the list that adds confusion. Okay, so this for me is, yeah, sure, it's job security, but in all honesty, I wish things were more simple because some of this stuff just doesn't need to be this complicated. But at the end of the day, if you do know how to optimize your financial situation and you understand how these rules work and you understand how to take advantage of them, then you're going to put yourself in the best position for the long term. So let's dive in and let's help you get better at understanding exactly how this is and how it works. So I just have to let you know here that nothing I'm going to talk about today is individualized financial advice, okay? This is going to be a general discussion. Please don't take this as specific advice for your situation, but also understand that I am doing my best here to try to help you really understand how this stuff works. And so I am going to give you some specific things here, but I always do recommend you speak to a financial professional before you do anything on your own. All right, so who is this for? This is for anyone wanting to understand Social Security taxation and how to either reduce their taxes or leverage Social Security more effectively in their retirement income plan. So whether you have already claimed your benefit or are in the process of your decision, this is for you. All right, so some important things here to consider. So what we'll be covering today are what are the important things you need to consider when making your Social Security decision. The different amounts your Social Security could be taxed. So there's different levels, 3 different levels your Social Security could be taxed at. What the provisional income formula is and how it determines whether your Social Security will be taxed or not. This is very important. The income levels when your Social Security becomes taxable and why you may get a surprise in 2023. We'll talk about some case studies on taxation and Social Security claiming strategies. So the case studies on taxation and Social Security claiming strategies are something that I really want you to pay attention to because this aligns with very similar things that I see when I speak to quite a few people as far as the clients or also people that might be coming in wanting some help. So I put some things together to help you understand them. And then we're going to talk about some general tips to help you plan your retirement income strategy. Okay, so hopefully this is helpful. I am going to introduce myself here. Many of you know me already, but I'm just going to go ahead and introduce myself to make sure that we're all on the same page here. My name is Jason J. Hamilton. I am a certified financial planner, a chartered retirement planning counselor, and a member of the Digital Assets Council of Financial Professionals. I'm the founder of Keep It Simple Financial Planning. We are an award-winning registered investment advisor located in Southern California here and managing over $40 million of assets. We recently voted most client-focused retirement planning firm in Southern California by Wealth and Finance International. We've been voted the top 10 wealth management service companies by Financial Services Review and the best financial advisor in Orange by expertise.com. So we got that award 2 years in a row. I'm also the founder of Keep It Simple Wealth Academy, and we specialize in helping clients get into alignment with their wealth and automate their plans for financial freedom. Okay, so let's dive in here. So what are some things you should be considering when claiming Social Security? And by the way, the Social Security site is an excellent place to start. I highly recommend you just read through that site. There's some very good things there. So a couple of these things I pulled off there and a couple of them are my own. So some things to consider. Are you working? Because if you're working when it comes to claiming your Social Security and you can plan to continue to work, there are limits on how much you can earn the year between age 62 and full retirement age and still get all of your benefits. So a part of our discussion today, a big part of it is going to be the discussion around, well, when do you claim? Should you claim at 62 at the earliest age you possibly can? Should you wait to a later date like full retirement age and or possibly even later like 70? Those are all considerations that you're going to have to make with your Social Security decision. So some of these questions are going to align exactly with those particular questions. So before full retirement age, and for most people, full retirement age is somewhere between 66 and 67. Okay, 67 is now, for anybody, I believe it's 1960 or later, it is 67. But before full retirement age, Social Security will deduct $1 from your benefit payment for every $2 you earn over the annual limit. So let me say that again. Before full retirement age, Social Security deducts $1 from your benefit for every $2 you earn above the annual limit. So for 2023, that limit is $21,240. So I'm talking about these things here because I want you to understand how Social Security works. Taxation is important, but you also need to understand the basics of Social Security so that you can put this whole thing together. But in the year you reach full retirement age, Social Security will only deduct $1 in benefits for every $3 you earn above $56,520 for 2023. So this is something, again, this is only in the year you reach full retirement age. So this counts for the months up to full retirement age, but then once you reach full retirement age, there's really no limit. There's no deductions at that point. So as I mentioned here, this only counts earnings up to the month before you reach your full retirement age, not your earnings for the entire year. And something to be reminded of, if you do face one of these potential reductions, well, the Social Security Administration is going to recalculate your benefit after you reach full retirement age, and they will give you credit for any months you did not receive your benefit because of your earnings. So when additional earnings appear on your record, they're going to check that and they're going to see if they should increase your monthly benefit. And if they do, then they're going to send you a letter telling you your new benefit amount. So this is something that it's not like you lose it forever on this reduction here. You lose it for today, but then after full retirement age, your benefit will be recalculated, okay? Still kind of sucks to lose it. And the thing is, if you're going to be earning, let's say, $60,000 prior to your full retirement age year, and maybe a far majority of your Social Security benefit is not going to be received, yes, you will get your benefit recalculated. But what you're giving up is your delayed credits, right? You get credits for delaying Social Security past full retirement age. And the nerd level formula is 0.05% per month. Okay, that's the nerd level formula. In reality, it's just under 6%. Okay, so it's about 5.75% per year that you lose for every year you withdraw early prior to full retirement age. And then after full retirement age, you get a 8% credit going forward. And you have to remember, this is a compounded credit. Okay, so this is a very valuable credit. And this is why you might hear me say that Social Security is the best annuity you can get. So for those of you thinking about dropping a big chunk of money in your annuity or buying an annuity through the open market, you really want to take a serious look and think about possibly delaying Social Security and using that money to replace that year of income that you might be losing. Because getting this extra benefit each year, that's going to be somewhere between 6 to 8% on average, plus your cost of living adjustment that's added on top of that, and that money being compounded each of those years going forward, it could be a big value. And I'm going to talk about a scenario here on what it might look like for you to consider delaying Social Security. But these are all things I want you to be aware of because a lot of people don't quite understand how this works. So I want to make sure we're really clear. All right, so next thing to consider after your work is, what is your life expectancy? Because life expectancy is a huge variable in deciding when to take your Social Security benefit, right? Because if we knew exactly the day you're going to pass away, I can tell you to the day when you should claim your benefit, whether it's 62, 67, 70, or somewhere in the middle there. But we don't know that, okay? So this is really a partial guess at the end of the day, but we do have some data that's available, okay? So this is from socialsecurity.gov, and this is as of April 2022. So life expectancy for men reaching age 65 on April 1st, 2022 is 84.1 years, okay? And for women reaching age 65 on April 1st, 2022, life expectancy is 86.7. So remember these dates because this is very important, because one of the decisions, okay, along with, as far as when you want to claim, is what your break-even date is, okay? And that's what we're going to talk about next. But the far majority of people are going to come out ahead based on, this data here by delaying their Social Security. Okay, so some people just can't delay. They need the money. Okay, I completely understand that. That's not kind of what we're talking about here. I totally understand if you're not able to work for some reason, or you just simply need to get the money at 62 to pay the bills. Totally understand that, and there's nothing wrong with that, by the way. But some of you have some additional money saved, and you might have some options on how to optimize your Social Security strategy. So that's, something to think about here is, break-even age is generally going to be around 78 to 80. That's kind of 78 to 81, somewhere in that range. So pretty much everybody's going to come out ahead. But these life expectancies, these averages, mean that half the people are going to live longer than this, right? So this is very, very important to think about when you're coming to make your Social Security decision, right? So some things to consider here are your family history and your lifestyle when thinking about your life expectancy. So if you come from a family with a long life expectancy, you may need extra money in the later years of retirement. So by delaying your Social Security, you're going to have a much bigger floor benefit or foundational benefit. And this is particularly important if there's a chance you may outlive your investments and other savings accounts, because that will give you more money to cover your bills. So something very important to think about. All right, the next thing to consider here is, what is your break-even age? So let's look at an example here. So a break-even age for somebody turning 62 with a $2,027 per month benefit at 62 would receive about $2,896 per month at age 67. So it's a pretty big increase. This is a 30% increase for life. That is also when you get those annual adjustments. So last year for 2022, we got an 8.7% annual cost of living adjustment on our Social Security. And if you get the 8.7, you're going to get 8.7 on either, the base amount, that 2027, or your FRA amount of 2896. That's a big difference. And you got to remember that continues to compound over time. That continues to grow over time like compound interest. So again, these are all things that we don't know for sure what's going to happen, but it's something to think about. And so in this case, the break-even age would be 78 years and 7 months. So if you think you're going to live beyond 78 years and 7 months, well, then the break-even age, this part of the decision, makes sense for you to consider delaying. As I mentioned before, 84 and 86 or so, 85 and 87 is kind of somewhere in that range is the average age for men and women. So the far majority of people are going to benefit from the break-even question. Okay, that's something to think about. The break-even question is very important. All right, and then our next consideration is, what is your base income need? Okay, because base income need, I think, is a really important way to think about your Social Security decision, because the more of your base income need that you have covered from guaranteed income sources, the more comfortable and confident you're going to be, and the easier you're going to sleep at night. Okay, we're just coming off a year where the market had a negative 20%, beyond actually over a negative 20% return. But if you had Social Security and a pension, for example, that covered all of your income needs, you probably weren't stressed out at all. You just didn't draw from your accounts or didn't draw as much as you were before. But if you had a Social Security need that only covered 30% of your income need, and you had to draw the far majority of your income from your investment accounts, well, that is something that could put you at risk later down the road in retirement. So your income need is a very important decision when it comes to how to optimize this. So let's do an example here. So let's go back to the previous example using those numbers. And let's say this particular client's income need is $4,000 per month, which, again, very common income need for many, many people or less. So if you were to draw Social Security at 62 and you drew $2,027 per month, that would be about 50% of your need. So half your need would come from guaranteed, half your need would need to come from other sources. That'd be savings or retirement withdrawals. But if you waited till 67 and we had $2,896 per month, this would cover 72.4% of your need. So that's 3/4 of your need. And so only 25% would need to come from an outside source like an investment account over the long term. I completely understand we need to fill the gap somewhere between 62 and 67, but are there options like part-time work, for example? Because most people these days, even though they can financially retire at 62, a lot of people feel really good. They have energy. They don't really want to sit around. They don't really want to do nothing. Traveling definitely comes into play for quite a few people. But I'm seeing more and more people at that early 60s ages when they could technically retire financially, wanted to pick up a part-time job. So if they made $2,000 a month, which I think is very reasonable, that's basically what your Social Security would have been anyways. And so now you can let your benefit grow and compound and delay. So, and then, another way to do it is if you have a fund set aside, then you could just draw from your accounts early. And remember, by the way, that if you have no other income sources, we're going to do an example of this, but if you have no other income sources besides whatever you might draw from your retirement accounts, you might not pay very much tax on money you're taking out of your 401ks or IRAs. So this is actually probably a smart thing to do, because you're going to get some of that money you might have deferred taxes on at 20% or higher rates. And now you're going to pull it out and you might only pay an effective rate of 5% or 8%. That's very reasonable to say. And then once you take your Social Security benefit, you have to remember, you're always going to have that foundational part for your income that is then I'm going to fill up the lower brackets, maybe the standard deduction or a little bit more. And then from there, everything is going to be taxable coming out of your retirement accounts at 10, 12, 22. So these are all things that you want to bring into play when it comes to designing your retirement income strategy. But this particular portion here is important because the longer term, so if you have 72% of your income need covered and you run out of money or very close to it at 85, well, you're not going to have to make very many adjustments to be able to survive, right? It's a lot different than only half. So that's why I bring this up. Okay, so let's dive in. So now we're going to get a little bit into the meat and potatoes here. I'll try to make this very simple for you, but it is a little bit technical, so stay with me. But I want you to understand and take away these points, because if you can understand how Social Security taxation works, you're going to be able to make better decisions on whether you delay, how you withdraw from your retirement accounts, and then how to optimize for taxes each year going forward. So we're going to dive into this a little bit here. So Social Security taxation, what do you need to know? The main thing you need to know is that Social Security benefits are subject to taxation only if the worker's total provisional income exceeds the certain thresholds, okay? Let me say that again. Social Security benefits are subject to taxation only if the worker's total provisional income exceeds certain thresholds. So if your only income is Social Security, then there is no taxes. You don't pay any tax on that. But once your provisional income exceeds certain amounts, well, now your Social Security becomes taxable, and you need to think about this when it comes to how do you plan your distribution strategy. So what's the formula here? The formula for Social Security taxation under this provisional income calculation is as follows. You're going to take your adjusted gross income that excludes Social Security. You're going to add any non-taxable interest like muni bond interest, and you're going to add 50% of your Social Security benefit, and that's going to equal your provisional income, okay? So adjusted gross income, so all of the income sources. So if you have no other income sources, then that's zero, right? But if you have a $60,000 pension, that's going to count. So you need to think about that. The $60,000 pension is going to be the foundation. So from there, you would add any non-taxable interest and 50% of your Social Security benefit, and that's going to equal your provisional income, okay? So once you understand your provisional income, then you understand how much of your Social Security will be taxed. Again, confusing, but I'm going to go through some examples here. 70% of Social Security recipients pay no tax on Social Security. So this is the thing, okay? So if 70% of Social Security recipients pay no tax on it, then this makes me think that a lot of people are living only on Social Security or very little beyond that, okay? So for those of you that have a lot of stress about the government completely canceling Social Security, my question is, what do you think is going to happen if we completely cancel Social Security? I think it will be absolute chaos and the world will burn down. So I do not think Social Security is going to be completely canceled. Social Security benefits, even if we didn't make any adjustments by it's about 2033, 2034 right now, we made zero adjustments, Social Security would be able to be funded about 78% of its current amount. So something to think about when you're doing your retirement planning is, what would it look like if you received a 22% haircut off your Social Security? What would that look like for your life? Again, I don't think that's going to happen if you already claim Social Security by 2033 or 34. But for those younger folks like me in their 40s, this is something I'm taking very seriously. But there are options that the government can definitely put into place, and it really revolves around increased taxation. That's probably going to happen, where I think Social Security will still be extended, but about 70% pay zero tax. About 15% are taxed on the 85% of their benefit due to high incomes. And then the final 15% are in the middle income range where the tax on their benefits is starting to phase in. So there's the 0%, the 50%, and the 85% percentage of Social Security. Okay. So depending on your provisional income, you could pay tax on up to 50% or even 85% of your Social Security benefit. This is what you need to be thinking about and understanding as you are looking to plan your retirement income strategy. Benefits are tax-free if your provisional income is less than $25,000 for those filing as single or head of household, or $32,000 for those who file a joint return. So it's kind of crazy to me to think that 70% of people are below these numbers. So that really shows like what the average retiree's income is in this country, which is very low. So this is where I completely understand the stress of inflation right now, because if your income, your provisional income is below these amounts, and then, eggs are $7 or $8, which is what we're seeing right now, that's going to put a lot of stress on things. So I completely empathize with that, and it's really sad to see. But this is what the situation is that we're in. So we just need to deal with what it is. So Once again, I'm going to remind you of this formula because we're going to go here and talk a little bit deeper about it. So the provisional income is calculated as adjusted gross income, excluding Social Security, plus non-taxable interest, plus 50% of your Social Security benefit. That equals your provisional income. Okay, so if your provisional income is between $25,000 and $34,000 on a single return, so that you file as a single filer, or $32,000 and $44,000 on a joint return, for every $1 of income between the lower and upper bases, 50 cents of Social Security benefits become taxable. So up to 50% of the total benefit. So you have to understand that this goes in stages. It doesn't mean the whole amount is taxed at a certain rate. It's the amount of provisional income between these brackets, okay? Between 25 and 34 or 32 and 44. If you're between there, the income between there is going to be taxed at 50%. And then once you get past $34,000 for singles or $44,000 for married couples, then for every $1 above these thresholds, 85 cents of Social Security benefits becomes taxable, up to a total taxable amount of 85% of benefits. Okay, so this again is on your key numbers guide. But here's a visual. Let's talk about a visual here. So the income, when you calculate your provisional income, adjusted gross income plus non-taxable interest plus 50% of Social Security. You add those three things up. If you're below $25,000, then your percentage of Social Security income tax is zero, okay? It's zero. But then once you get to $25,000 plus to $34,000, this amount in here is taxed at 50%, and that's for singles, by the way. So it's in that $9,000 range here for singles, and it's a $12,000 range here for married filing joint. Okay, so for married filing joint, it's $32,000 to $44,000, and then any income, whenever your income is above $34,000, 85% of the benefit becomes taxable. So it's taxed at whatever your rate is. So if your marginal tax rate is 10, 12, 22, 24, that 85% of the benefit is going to be taxed at that tax rate. All right, so Social Security taxation. Regardless of the level of an individual's provisional income, 15% of your benefit will be tax-free. I used to say always tax-free, but I changed that because who knows what's going to happen. The 15% of that benefit is still tax-free. That's something that may change, by the way. You know, that is something that could easily be changed as part of the extension of Social Security. All right, so one thing to know, that this is very important, by the way. These thresholds are not indexed for inflation. So that means more of your Social Security benefits each year are taxed due to cost of living adjustments. So this is really important, okay? So with 2022 giving an 8.7% increase, be sure to review your tax projections for 2023 to avoid any surprises on your tax bill. Because very easily, you could have possibly been in the 12% bracket last year, and now with the increase, now you're going to a 22% bracket, and you might get a nasty surprise where you owe more taxes than you think due to your Social Security increase, or maybe due to an income increase elsewhere. So really, really important to think about. Okay, so let's talk about a couple case studies here. We've got our good buddy here, Indiana Smith, born 6/1/61, which means he will be turning 62 this year. Indiana gets a $2,000 a month pension starting at 62, so that's $24,000 a year. So that's coming in no matter what. And these are his Social Security options, okay? So we're going to look at 62, 67, which is full retirement age for him, and 70. So at 67, he will get $36,000 per year, and the break even is 78 years and 8 months. And at 70, he will get $44,000 per year, and his break even is 80 years and 4 months. So if you think about that, we're only like another year and a half to break even. So if you wait till 70, as you can see, you're going to get a lot more to start with. So the break even happens very quickly. So when I hear people very concerned that they just want to get their money at 62, I understand that. But please take into account your longevity, because if you do live longer than expected, delaying your Social Security could be really valuable too. So again, so pension income here is $24,000. His gross Social Security is $27,300. Taxable Social Security income will be $7,603. So his adjusted gross income is just the pension income plus the taxable Social Security. He does not have to pay tax on the whole thing, because when you add up his pension income plus 1/2 of his Social Security benefit, then his only amount of his taxable Social Security is $7,603. So really not that big a deal. So his adjusted gross income here is $31,000. $17,603. So after the standard deduction, Indiana is going to only pay $1,910 in taxes. So what we're doing here, just to be clear, we're taking our adjusted gross income, we're subtracting the single filer standard tax deduction of $13,850. That leaves us with a taxable income of $17,753. And so the taxes owed for Indiana in this case would be $1,910, $1,910. So pretty minimal, okay? Very minimal tax rate. What's going to happen though if Indiana needs more money? So in this case, we're going to show an example of what would happen to Indiana if he took $16,000 from his IRA to purchase a car. This is something that, you have to really be careful when you're going through your withdrawal strategy, because you can very easily bump yourself into, other tax brackets, not only other tax brackets for the marginal rates, also for the Social Security rates. So going back to his foundational income, $24,000, but if he were to take out $16,000 from his IRA to purchase a car, we have to add that, right? So that's $24,000 plus $16,000 because that's a taxable distribution. So that's $40,000 of income. So now his taxable Social Security went from $7,603 to $21,203. Massive jump on the amount of Social Security that is now taxable, that he has to pay at whatever his tax rate is. This brought his adjusted gross income from $31,603 to $61,203. So think about that. He took $16,000 out, but because of the way Social Security is taxed, he now bumped himself up from being in a very low taxable bracket for Social Security to now being a higher bracket, and now his adjusted gross income he's got to pay taxes on is $61,203. So what he's done is he's increased his taxable income by $29,600, and now his taxes owed went from $1,910 to $5,725. So his effective tax rate on that $16,000 is about 35.8%. And on the last $1,000 he took out, it's 40.7%. Okay. So this is a big deal. So by taking just $16,000 from his IRA, he increased his taxable income by $29,600 and essentially paid 35.8% tax on his distribution. Okay. Pretty mind-blowing when you're looking at distribution strategy and how these things work. Very, very quickly can you jump yourself up and have to pay a lot more tax than you're expecting. So this is where, when it comes to your plan, you really want to think about how you're going to make big purchases, for example. So if you need to buy a car, well, maybe you don't want to take Social Security right away before you purchase the car. These are things to think about when it comes to the overall cost, because that's a huge cost to just take out $16,000. And then additionally, if he were to continue to work and earn over $21,240, then his current benefit would be reduced by $1 for every $2 he earned over the limit. If you plan to draw at 62, make sure you understand all the income and tax ramifications. All right, so next case study here. Garcia family, both 62, and they will be turning 62 this year. Currently, they have no other income sources. They've heard good things. They've heard this thing about the Roth conversion. Roth conversions are the best thing in the world, which they're very good, by the way. But they are saying, okay, so should we do a Roth conversion? Should we convert money to Roth? This is something that a lot of people ask me about, and a lot of comments come up in the group. So here's their scenario. They have a large pre-tax account. They will receive a pension at 65. The pension and Social Security will cover their needs after claiming. And so they're also considering when to claim Social Security. These folks have a lot of money saved up in a 401k. They delayed their income all the way to retirement. They don't have a lot of Roth money. And so the tax man is coming for his share. All right. Uncle Sam is coming for his share. So this family will receive a pension at 65, and with the pension plus Social Security, it's going to cover their needs. So now they're talking about Roth conversion and also when they should claim their Social Security. So here we have pension income of $60,000. And if they were to wait till 67, their Social Security would be $60,000. Their income need is only currently $75,000. And so by the time the Garcias are 67, they're already going to be earning $45,000 more than their current need. If you're somebody who, between pensions and Social Security, or a very small withdrawal from your IRA, are going to have more money than you need coming in for retirement over the long haul. Maybe not the early years when you're spending extra for vacations, but let's say after 73, when you have to start taking your required minimum distribution, You really want to think about this because this planning strategy can be massively powerful for you. So let's talk about considering Roth conversion. What should the Garcias consider when it comes to doing a Roth conversion? First question is, will the Garcias need distributions from their retirement account to fund their retirement income plan? The answer is no. Between Social Security and pension, they have enough money. Do the Garcias expect their beneficiaries to be subject to high income tax rates in the future, or will they be in a higher tax bracket in the future? So their kids are very successful. They're lawyers, doctors, so they're expected to be making very high income later down the road. So in this case, yes, both of these answers are yes. The kids, the beneficiaries will be in a higher tax bracket, and also the Garcias will be in a higher tax bracket in the future, mainly from RMDs for them. Do they have cash to pay income taxes outside of their retirement accounts? And in this case, the answer is yes. So do they have cash to pay income taxes outside of their retirement accounts? And in this case, they do, which is yes. By the way, if you don't have cash outside of your retirement accounts to pay tax on a Roth conversion, it does not mean it's not as beneficial. It's just less beneficial. Okay. But in this case, we're going to say yes, that they do. The Garcias are excellent candidates for Roth conversions. About that a little bit. What are some benefits of Roth conversions? And for those of you that don't know what a Roth conversion is, what that means is you're going to convert money from a pre-tax account, like a traditional IRA or 401k, and you're going to transfer it over to a Roth IRA. That is a taxable transfer, okay? But these are some benefits here we'll talk about in a second. And the thing with the transfers is there's no limit. So I get this question a lot too. Well, I'm not working, so I can't convert, right? No. There's another C word, and that C word is contributions. So if you're not working and you have no earned income, you can't contribute. But in any case, whether you're working, not working, doesn't matter your age, you can convert unlimited money, whatever is in your pre-tax accounts, over to a Roth IRA. Now, I do not recommend converting all of it in 1 year, generally. I do recommend figuring out what the best tax bracket is for you and maximize that tax bracket. But the far majority of people in this situation that have a large pre-tax account with a small income need and a lot of fixed income can generally benefit from doing a Roth conversion. What are some benefits of Roth conversions? After your death, income tax-free distributions will be advantageous to your beneficiaries. So when you pass on your account, you have to remember that all IRAs now have a 10-year distribution requirement. So after the date of death, the whole IRA has to be distributed within 10 years. So if you leave behind a big IRA, $1 million or $2 million or more to your children, for example, and let's say they're high income earners, that's going to be taxed at some of the highest tax brackets available, and you might lose 30, 40, or 50% of that income over time. So really important to think about. Second thing is inheriting Roth assets will be particularly valuable to the non-eligible designated beneficiaries. So if you are a non-eligible designated beneficiary, you are subject to the 10-year rule that I mentioned, and that's going to accelerate distributions and taxation if the assets remained in a traditional IRA. So it's a benefit to put it to Roth. And then the third benefit here is amounts converted now are not subject to RMDs at 73. So if you convert, let's say you're 62 and you start working on your conversions and you get a bunch of money into your Roth accounts, you're not going to have to take that money out of a pre-tax account at 73. That money is going to compound forever. So if you're somebody who has most of your income needs met by a pension or pension and Social Security, then you're not going to have to worry about these big tax bills later, because it can be a very surprising tax bill if you do not have a game plan and you just let your pre-tax account grow, and then at 73, just wait for things to have to take out. How much should you convert? So after analyzing the Garcia situation, it seems like they will be solidly in the 12% bracket later in retirement. So this is prior to RMDs, okay? But they'll have only about $6,500 of room in the 12% bracket until they hit the 22% bracket. And so the 12% bracket is going to go back to 15 if nothing changes after 2025. And the 22% bracket is going to go to 25% after 2025. So that's why I put 22/25. But after RMDs begin, they will be in the 22/25% bracket or higher forever. If one of them passes away, you have to remember the widow penalty, okay? The widow penalty is if one of the spouses passes away, then you got about 2 years, the year they pass and the year after, I believe. And then after that, that person that remains behind goes to single filer tax brackets. So that widow penalty can be a massive number. And then that can also lead to additional taxes on things like Medicare. The IRMA, Aunt Irma, as we call her, income-related monthly adjustment amount. That can be a penalty there too. So by planning and looking at this strategy, Roth conversions early and potentially delaying Social Security, you start putting these variables together and you create this harmony of all these different aspects of your plan that are working together like an orchestra so that you have a better experience long term. And this is where it really benefits you to get in touch with somebody who knows what they're doing with this stuff, because if you're trying to do this on your own, it's really difficult to optimize. You really have to have a lot of tools available and a lot of knowledge. But let's take a look at this situation here. So if we look here, this is a projection of what the Garcia's income tax brackets are going to look like over time. So starting at their age 62 on the left side of the graph here. So we're over here on the age 62, and these are the tax rates, okay, that they're expected to be in. This is their effective tax rate. So they're going to be in a very low effective tax rate between 62 and about full retirement age, because in this plan, we have them taking Social Security at 67. So if we were to do that, now we see a big spike in income here. And then what happens here at 73, boom, we see another big spike in income because the RMDs come in. And then that basically goes up forever and ever and ever. And this will just be larger if one of them were to pass away. Have them both passing away here at the same time, or else if one passed early, this would spike even more. So if we were to look at some conversions, what we would do is we would fill this bracket. Okay, so we would fill this bracket up over here. And once you do that, things are going to look a lot smoother. And now we're going to smooth out the tax brackets. We're going to keep things lower here, max out this 12% bracket. And then as we get over to this side, we're going to be paying less taxes over time because now our RMD is going to be a lot smaller. So this is only going to a 12% bracket. If we went a little bit higher, we could convert more even faster and have more money in a Roth account. So this is all about creating a better experience for you over time and maximizing the lower brackets. But if you just take all your Social Security income for both spouses at 62, well, now you're filling up those lower brackets and you're missing out on a potential opportunity to get a lot of money from your pre-tax accounts, like 401ks and IRAs, to Roth accounts that'll grow tax-free forever, okay? So for the Garcias, since they have no other income this year and they decided to convert their money to the 12% bracket, it looks like they can convert up to $117,000 to maximize the 12% bracket. So they can get $117,000 and not pay over anything over 12% in taxes. And actually their effective rate is going to be much lower. So this is something, again, to consider when it comes time to make your decisions. So if we were to put up to $117,000 in a Roth account, that's going to be a big number over time. So the federal tax owed on that will only be $10,276 at an effective rate of 8.8%. So what you have to remember is you might be maximizing 12% bracket, but that does not mean you're going to pay 12% tax on all of your conversion. You're only going to pay it as the brackets go up. So you're going to start at the 0% bracket, which is the standard deduction, just over $27,000. And then you're going to have the 10% bracket, the 12% bracket to fill up. So for the Garcias, they're looking at about, for the 12% bracket, they're looking at about $89,450 that they can convert plus their standard deduction, right? And still staying at 12%. That's where we get the 117. But your effective rate is only 8.8. So if we followed this strategy from just age 62 to age 66 prior to Social Security, with growth in the account of an average rate of about 6 or 7%, their Garcias would have about $690,000, which is after-tax dollars in the Roth IRA account that will be tax-free forever. So following the strategy from 62 to 66 prior to Social Security, with growth in the account of about 6 or 7%, the Garcias would have about $690,000 of after-tax dollars in the Roth IRA that would be tax-free forever, okay? It's a big deal. It's a really big deal. And so the federal tax paid during this time is estimated to only be about $47,518. So that's just over an 8% average rate. So just an 8% effective rate during this time, which is much better than the 25% rate they're going to be in the future. So if they waited to RMDs, all this money is going to have to come out anyways, the far majority of it. So it's all going to come out at 25% or more later in retirement. So by planning ahead, the Garcias are really setting themselves up for a better experience, and they're going to save a lot of money on tax. So this plan, by following this, estimates that they will save about $167,758 by following this plan over time, because their tax rate is going to be lower. So as you can see here, the taxes over time are going to be much lower at the dark blue versus the purple here. And so again, we're not converting everything to Roth, but we're going to really maximize those first 5 years of retirement. And we may do a little bit more after, but after that, they're in the 22% bracket forever because they have their pension and Social Security. You may not be in the 22% forever, so this is something for you to consider. So another case study. What if you want to claim Social Security and you live to 90, okay? What if you wait to claim Social Security and live to 90? How much more in Social Security income would you be expected to receive? Because some people don't understand the ramifications of actually waiting to claim Social Security. What does that mean in dollars to you that you'll receive? So I have a projection here for you what this might look like. So what is it worth to be patient? Because I know a lot of people aren't really good with patience. So we're going to use this same example we used before. $27,300 at 62, $36,000 per year at full retirement age with a break even at 78 and 8 months, and $44,400 at 70 with a break even at 80 and 4 months. So in this case, this is an example here of comparing full retirement age to claiming as early as possible, which would be 62. So if we waited till full retirement age and we live to 90, okay, this is assuming we live to 90. You could live less than this. So this might be worth less, but if you live beyond 90, then this is worth more. So by delaying from 62 to full retirement age and you live to 90, this is estimated to give you $212,875 more from Social Security income. So this means you're going to have to take less from your retirement accounts over time, right? This is a big deal, which means more money in retirement accounts, more money to pass on as inheritance. If we go to age 70 here, well, now we're looking at $338,202 more at age 70 from delaying Social Security. So it's a really big deal, right? It's a really, really big deal to consider delaying how much you'll get. But again, you want to consider other factors like life expectancy, other income sources. That's all obviously part of the equation. But these are not small numbers. So looking at optimizing a Social Security strategy, as I'm showing you here, could be worth hundreds of thousands of dollars to you. It really is a big deal. And here's the other thing. So this is something you can see. So at age 80, and this is delaying Social Security to 70. So if you delay Social Security to 70, if you would have taken it at 70, you would have $61,544 coming in as guaranteed foundational income. But if you compared that to what you would have by taking it at age 62, you'd only have $34,742. So this is what I'm saying. For those of you that may have a possibility of running out of money later down the road, having this larger Social Security benefit could provide a lot more security as well, especially if you have longevity in your family. So very, very important things to think about. And then the other thing is, this is about 77% more stable income for retirement. Big number, okay? All right, so that's it for our case studies. I'm gonna give you some final tips here before we wrap up. So tips to maximize your Social Security benefit. One important one is working for 35 years or more, because this will help you ensure you get the most money when your benefit is calculated. You have to remember that your Social Security benefit is based on your top 35 earning years. And if you worked less than 35 years, then you get what's called a zero. So if you have been to a basic math class, if you divide by zero, that's going to hurt your benefit significantly. So making sure you got 35 full years in is very important. Another thing is earn as much as you can right up until full retirement age or past it, because your benefit keeps calculating. So if you keep working and earning, your benefit's going to get recalculated and it's going to grow if any of those current working years are more than an early working year that was being counted for that 35 years. So if you grew up and you were flipping burgers, making minimum wage, my first job was $4.25 an hour making sandwiches at Subway. I know for sure my later years, even if I work part-time, are probably going to be more than that. So all of those years are going to cancel out those early years that I earned as part of my particular Social Security calculation. So that's something you can do for yourself as well. Another big one here, like we talked about in the case studies, by delaying Social Security, you may be able to withdraw tax-free from your non-qualified retirement account or 401ks or IRAs. So this is important. If you go to your 2023 Key Numbers Guide, look at the capital gains tax brackets. Because if you're married, you can take out up to almost $90,000 in capital gains tax-free if you have like a taxable account, like a brokerage account, or just single stocks, for example. If you have no other income, the capital gains brackets stay 0% up to almost $90,000 for a joint filer. So this could be a very powerful strategy to get some money out of those old stocks with low basis. Even if you reinvested it right away or within, like 30 days after, because you don't want to do a wash sale. But if you invested it right away after and in the same exact stocks, and then you claimed all that, you harvested all that gain tax-free, what's that worth compared to taking a Social Security benefit, a couple years early? So again, all things to think about here. And then the final one here is consider larger Roth conversions prior to claiming Social Security to save on taxes in the future, okay? So I hope this was helpful for you. I'm going to put my website up here and let you know that we do have a few appointments available to discuss. So I do offer complimentary consultations, and we will speak with you about your retirement situation. And a few people lately have been really surprised on how deep we got on that conversation. But what I want to do on these calls is really help you figure out what you need to do. What your game plan needs to be for your next steps. And if you're somebody who looks like a really good case for some more of this advanced planning or for some assistance, or honestly, if you just want to get some help making sure you're on track for retirement, I would love to speak with you, okay? Because this is what we do. We specialize in retirement planning, and we really would love to help you put together your plan. We have all the tools to help you optimize the variables. We have everything that you could possibly need to look at whatever situation you have to make sense of it, okay? Because I know sometimes this can be confusing. Just this weekend, I was helping a client, one of my first clients, by the way, beautiful family, but it was time for them to decide on their pension, and their pension had 18 options, okay? 18 options for their pension. Absolutely crazy, right? So 18 options is just insane for any one person to try to figure out. Even I was like bringing myself back and forth. But once I took the time to understand it, help the client understand it, now they're making a confident decision going into the next stage. And not only that, we found a great option that's going to give the spouse much higher income for them if the first spouse were to pass away. So these are all things we can talk about. And some of this stuff we're not going to be able to do on one call, and we might need to do some work together. But if you need help with tax planning, you need help with investments, you need help with optimizing your Social Security, optimizing your pensions, these are all things that are just another day of the week for us. But maybe for you, you'd like some help with that. So the website here is keepitsimplefinancial.com/talk. Like I said, the spaces are very limited currently because we're a little bit busy, but we are looking to help some people out and get you on track as best as we can for the next stage of your life. So folks, I hope this was helpful for you. I really appreciate you joining today. I really love doing this for the community. And if this was helpful for you, please share it with somebody. If you go to so this is also in the Facebook groups. And if you're not in the Facebook groups and you're watching this outside, you can find those on Facebook. One is called Your Retirement Coach, and the other one is called Retirement Planning for Beginners, okay? Sometimes I do the workshops in both. Sometimes I do separate ones in each one depending on the subject. But if you're on my Facebook page where it says Jason J. Hamilton Financial Planner, please share this. If you think someone can find this valuable, please share this with your community. I know there's a lot of people that could really benefit from these strategies. So again, I want to thank you so much for joining today. If you have any questions, let me know. And if not, then I welcome you to schedule a call if you want to talk further. And I'll wish you a wonderful rest of your week, okay? Thank you folks for tuning in, and we'll see you next time, all right?